a statutory responsibility for maintaining financial stability, and we have got a constitutional mandate to maintain price stability. An important part of the financial stability mandate is the communication of potential risks and mitigating policy actions to the public. The Financial Stability Review is the primary channel through which this is done. Since the publication of the previous review in November last year, the outlook for financial stability has improved. Incoming data have confirmed that a rebound in economic activity is underway, both internationally and domestically. Asset prices have also recovered, supported by low interest rates and improving investor confidence. Despite the severe disruptions caused by COVID-19, the provision of financial services has continued, with no major institutions facing solvency challenges to date. The ability of South Africa's financial sector to cope with a once-in-a-century recession and severe operational disruptions reflect extensive risk mitigating efforts from both financial institutions and from the regulatory bodies. In fact, South Africa's financial sector has not only coped with, but has played a key role in supporting the economy through the COVID-19 shock. In part, this reflects the fact that the sector entered 2020 with substantial capital and liquidity buffers, which ensured that institutions could continue providing key services such as lending and insurance. Important regulatory interventions also provided the scope for institutions to offer temporary support to clients facing financial strain, for example, through the restructuring of credit agreements. All this was only possible because when the COVID-19 shock hit our shores, the South African financial sector had adequate capital and liquidity buffers that we could easily dip into to continue to support economic activity. There is certainly cause for optimism, but some material risks to financial stability remain. The COVID-19 pandemic is not yet over, and its effects on the economy continue to be felt as employment and output are still well below their 2019 levels. Consequently, the share of borrowers that are behind on loan repayments is still relatively high, despite low interest rates and other regulatory support measures. A related risk is that debt in the domestic economy is at historically elevated levels, particularly for the public sector. The Financial Stability Review presents a detailed analysis of these and other potential vulnerabilities. At this stage, I would like to hand over to Alex Smith, who is going to show you some pictures summarizing the Financial Stability Review. Alex will also take you through this presentation of the key messages that are in these valuable publications. At the end of the presentation, we will have an opportunity for you to direct questions to members of the panel. Alex, over to you.
Thank you very much, Governor. I will now share the presentation. Right. Well, thank you very much, everyone, for joining in today. The presentation that I'm going to take you through has 4 key messages. The first is that, as the Governor alluded to, the domestic financial system has demonstrated a high degree of resilience over the past year, notwithstanding the challenges posed by COVID-19. And the outlook for financial stability is improving. However, as we look ahead, there are a number of material risks. But despite these risks, our systemically important financial institutions in South Africa well placed to absorb most plausible stresses that could arise in the future. So this presentation will have three parts. We'll talk a little bit about risks and then resilience, and then finally some of the policy actions that the SARB has undertaken, and I'll conclude with that. So beginning with risks, the SARB produces what we call a risk assessment matrix. This highlights key risks to the financial system, as well as the vulnerability of the domestic financial system to these risks. As you can see in this particular slide, we have three levels of vulnerability: limited, moderate, and high. And the color of the block is associated with the level of vulnerability. And we also, on the vertical axis, display the likelihood of the risk emerging. On the horizontal axis, the speed with which the risk is likely to emerge. So the FSR provides detail in each of these risks. I'll just touch on a couple of them in the presentation today, the most important ones. So, of course, the first risk is that of further COVID-19 flare-ups. That's quite a fast-burning risk.
Recording in progress.
Something that could emerge in the near term. Another risk that's fairly near-term in nature is the potential for a tightening of global financial conditions. And I'll talk a little bit more about that in detail in a few slides. The third risk, which we regard as being a high vulnerability risk, in the sense that the financial system is potentially quite vulnerable to it, is that government debt is high and expected to rise further. An additional risk on the operational side is that of a cyber attack. Cyber events have become more regular since the emergence of COVID, as more and more people are working from home, and there's been an increased dependency on IT systems and IT infrastructure. A slower burning risk is that of persistently weak economic activity. The economic outlook was relatively weak even prior to the pandemic, and obviously the pandemic has further resulted in a deteriorating economic activity in the near term. And so there remains a question mark around how rapidly the economy will recover from COVID-19. And then finally, a risk that we won't talk about too much today, but it is in the document, is that of climate change, both the physical and transition risks associated with climate change. So beginning with COVID-19, the pandemic remains a key financial stability threat. It has had a significant impact on the financial sector thus far, resulting in increased credit risk, larger insurance claims for certain products like life insurance, financial market volatility, higher debt amongst borrowers, and lower profitability for financial institutions. The speed with which the pandemic can be contained will be an important determinant of both the economic and the macro financial outlook. And certainly further waves of COVID-19 are possible and could cause substantial disruptions. One thing that we're looking closely at the moment is the rate of COVID-19 vaccination, which is, of course, an important measure to contain the spread of the virus. South Africa has been lagging behind its emerging market peers, as the chart on the right-hand side shows, with, I think, the most recent data suggesting about 1% of the population having received a vaccine dose, which is somewhat lower than some of the other large emerging market economies. So the pace of the vaccine rollout will be very important in the near term. What we can also see is that COVID-19 has had a lasting impact on the economy. This chart on the left-hand side is derived from the IMF's economic forecasts. And basically what the chart shows is the difference between the forecast for 2024 GDP initially in January 2020 versus in April 2021. So in other words, the change in the forecast from before COVID hit till the most recent forecast. Now, of course, the forecast can change for a number of reasons, but it's likely that a key driver of the forecast change has been the impact of COVID-19. And by looking at the 2024 forecast, it's possible to see a sort of a longer term impact of COVID out into the future. So what the IMF numbers demonstrates is that relative to a pre-pandemic scenario, South Africa's level of GDP in 2024 is likely to be about 7.5% lower. So that's quite a big hit, and larger than most other regions. For example, Sub-Saharan Africa as a whole is likely to see a hit of about 5.5% of GDP. Emerging market and developing economies about 4% of GDP, and the world on average just under 3%. So the South African hit of 7.5% demonstrates a very significant hit from COVID-19 itself. And clearly, I think it's also clear to see that advanced economies have been less badly affected economically than emerging market economies, even though in terms of infection rates, at least initially in the pandemic, advanced economies were worse off. This right-hand chart just shows the trajectory of GDP growth over time, including the SARB's forecast for the future. And I think most analysts will be familiar with the fact that GDP growth was slowing for a number of years before the pandemic hit. And then, of course, in 2020, there was a very severe recession. Encouragingly, growth is projected to pick up this year, but there remains a lot of uncertainty about the outlook on a medium-term basis. Now, switching to financial conditions, I did mention in our RAM that one of the key risks is a tightening of global financial conditions. So what we can see right now, the left-hand chart shows domestic financial conditions and the right chart, international financial conditions. And in both cases, financial conditions are incredibly loose at the moment, meaning that the cost and the ease with which financing can be accessed the cost is low and it's very easy to access finance, which is obviously a good thing, and it reflects the fact that central banks have undertaken a number of measures to try to support access to finance during this difficult period. However, it does also show, if we look at the international financial markets in particular, that these easy financing conditions have made it quite easy for people to buy up financial assets at low prices, and that has resulted in stretched asset valuations, particularly in the United States. And should these financial conditions tighten in future, that could result in disruptions in financial markets and potentially challenges with debt servicing. The reason that I refer to debt servicing challenges in particular is that on this right-hand chart, we can see that global debt levels are very elevated at the moment. They're at historic highs, both in emerging and advanced economies. And in the US, we're starting to see, as depicted on this left-hand chart, we're starting to see that the bond yields are rising in anticipation of higher inflation. So this blue line on the left chart shows the market pricing for future inflation over a 5-year period, and that's bounced back quite rapidly in recent months. And that does point to the fact that the very loose monetary policy conditions, particularly in the United States, might need to be rolled back somewhat over time, perhaps through a tapering of asset purchases. And whilst that is a perfectly normal policy response, it is possible that the financial market reaction to that could be somewhat disorderly or could be quite rapid, which in turn could translate into increased debt service costs, both in the United States and elsewhere, which is a risk that we are closely monitoring. Moving to the risk associated with public debt, I think it's quite clear that public debt has been rising over time. After bottoming out at about 26% of GDP in 2009, public debt rose to 63% of GDP at the start of 2020. And then through 2020 into beginning of 2021, public debt increased further to 80% of GDP. So a very substantial increase over the past year in response to the COVID pandemic, which resulted in a drop in tax revenues and also a fall in GDP itself, the denominator of the debt to GDP ratio. So this is something that we saw in a number of countries, the rise in public debt. but South Africa's increase has been one of the largest, and debt is expected to continue to rise further over time by the National Treasury. As a consequence of the fairly persistent increase in public debt since the global financial crisis, the sovereign credit rating has been downgraded a number of times. As you can see on this right-hand chart, in fact, by each of the three major rating agencies, the sovereign credit rating has been downgraded 6 times since 2010, and it now sits below investment grade status. Now, the fact that public debt is high and rising is not necessarily in and of itself a financial stability threat. It's really the implications that this has for the domestic financial sector that concern us from a financial stability perspective. So one of those implications is that the sovereign credit rating moves, or bank credit ratings move in lockstep with the sovereign credit rating because of the linkages between banks and government. So banks have also seen their credit ratings downgraded through time, which does have implications for debt service costs, funding costs for banks. What we also know is that domestic bank exposures to the sovereign have increased quite considerably in recent years. So this chart here on the left-hand side shows the year-on-year growth of exposures of banks both to the private sector, the orange line, as well as to the public sector. So we define the public sector here quite broadly. It includes holdings of government bonds as well as loans to general and local government, state-owned entities. And so the exposures to government have been growing quite rapidly for a number of years. And as a result of that, as a share of assets, government's exposures on bank balance sheets have increased quite sharply. And this has been particularly notable amongst the non-systemically important financial institutions. So those would be your smaller banks. But even amongst the largest 6 banks, we are seeing exposures to government as a share of assets that exceed 16%. So what this means, of course, is that volatility in government bond prices does have an impact on banks. And if there was to be any challenges on the part of government in servicing debt, that would clearly have a big impact on the domestic banking sector. So now turning to the resilience of the financial sector, it really is a good news story. Bank capital has remained stable despite banks experiencing lower profits over the past year. So the left-hand chart shows bank capital adequacy. The blue line there is the total adequacy ratio of the sector. And we can see that that line has remained relatively stable over the past 14 months or so, despite the substantial economic impacts of COVID-19. The pink line shows the minimum regulatory capital requirement. And what you can see there is that that minimum requirement was reduced by 1 percentage point in early 2020 as the pandemic hit, in order to try to stimulate lending and to ensure that banks remained able to provide credit into the economy. But despite that drop in the regulatory requirements, the actual level of bank capital has remained stable, and the surplus capital depicted at the bottom has remained quite high by historical standards. Now, part of the reason that bank capital has remained so stable is that banks have continued to generate profits, albeit lower profits than in years gone by. And also because banks significantly reduced their payments of dividends in 2020 on the back of a directive issued by the Prudential Authority, which helped to conserve retained earnings and ultimately to conserve capital in the banking system. Now, the governor also alluded to loan restructures that were undertaken in response to COVID. And this has been the most widely used regulatory intervention with respect to COVID-19. So banks have been able to restructure loans that were previously performing, but where the borrowers were temporarily affected by COVID-19. They were able to restructure those loans without having to hold additional capital against the loans, which would typically be required under a normal restructure. So this was a special regulatory intervention brought in, given the very unusual nature of COVID-19 and the fact that it put a stop to a number of business activities, but on a temporary basis. So we can see that this was very widely used, with almost 600 billion rands worth of loans being restructured at its peak in July of last year. What we are seeing, though, is that the number of active restructured loans is starting to roll off quite considerably. And as of February, it had dropped down to 293 billion, or just under 6% of gross credit exposure of the banking system, which is encouraging. But of course, there is still a substantial value of loans outstanding, which the quality of which remains somewhat unclear, and will probably also be influenced by the future trajectory of the economy. Default ratios in the banking system increased quite significantly in 2020, but we're now seeing signs that defaults are stabilizing as a share of total credit extended. What we can also see on this slide is that there's been quite a big differentiation between defaults for different loan types. So at the bottom here, we can see corporates, which excludes small and medium enterprises. Defaults amongst corporates have remained very low, at less than 2% of total credit extended. So that does suggest that your larger corporates have, in general, done better through the pandemic than households, at least in terms of loan repayment performance. And if we look at household credit, there's also been quite a big difference between secured household credit, such as residential mortgages, relative to unsecured loans, where default ratios are very high at around 17% of credit extended. But in all cases, we are seeing signs of a stabilization in the level of loan defaults. Turning now to the insurance sector, it's quite encouraging to see that insurers managed to grow their premiums earned in 2020, albeit only slightly. But despite the challenging operating conditions, premiums did increase. Also, assets increased by the end of 2020. Insurance assets initially took a hit in the first quarter of the year, and that is largely related to the fact that financial markets took quite a large dip, and many insurers are invested in bonds and equities and other financial instruments, the value of which dropped, but has since recovered. So insurance assets actually reached a new high level in December of 2020, just above 3.5 trillion rand. As a result of the relatively strong performance from the insurance sector, the capital, the solvency capital requirements of insurers has also remained fairly stable and well above the minimum regulatory requirements, suggesting that insurers remain well capitalized with the substantial capital buffers. As the governor also mentioned, domestic asset prices have been rebounding quite strongly in recent months. So this left chart shows equity prices with the all-share index having increased about 20% above where it was at the start of 2020. The JSE Financials Index remains a little bit below where it was at the start of 2020, but has also recovered considerably from its lows in March last year. And then on the right side, we can see house prices picking up quite nicely. In particular, if we look at real house prices, that maroon line, we're starting to see growth there for the first time in about 5 years. So when you adjust for inflation, house prices are increasing on a year-on-year basis for the first time in 5 years, which is quite encouraging and is likely linked to the relatively low interest rate environment. Finally, if we look at collective investment schemes, it's also quite a good news story there, in that collective investment schemes saw record inflows in 2020, in particular in the second quarter of the year. And just like insurers, the assets under management of collective investment schemes dipped quite sharply in the first quarter of 2020 as financial markets dropped, but have since picked up quite strongly, increasing above 2.5 trillion rand in total. So now turning to policy actions that have been taken by the SARB and the PA, a range of actions were taken to support the flow of credit and the economic recovery, whilst still maintaining the soundness of the financial system. As the governor mentioned, the fact that the banking and insurance sectors entered this challenging time with substantial solvency and liquidity buffers provided the scope to make some regulatory adjustments to dip into some of these buffers. But now certain policies are being returned to normal due to the resilience of the financial system. And these include that bank capital requirements are expected to be normalized from 2022 onwards. As you saw in that earlier slide, the capital requirements were temporarily reduced by 1 percentage point. The other thing that's being normalized is that the PA's guidance relating to the payment of dividends and bonuses has been relaxed. So in 2020, the PA noted that they expect that no distribution of dividends on ordinary shares or payments of cash bonuses to material risk takers should take place in 2020. But more recently in 2021, that guidance has been relaxed somewhat, noting, of course, that dividend payout ratios should remain prudent and commensurate with the risks that the banking sector faces. The loan guarantee scheme is also being wound down after facilitating more than 18 billion rand in credit. It is worth noting that a number of other policy interventions remain in place to ensure that financial stability is intact. And finally, it is worth noting that the Financial Stability Committee of the SARB has maintained the counter-cyclical capital buffer at a 0% level with due cognizance for the state of the current financial cycle. So to conclude, the financial stability outlook is improving as loan defaults have started to stabilize and the economy is recovering nicely from its trough in 2020. But risks relating to the durability of that economic recovery, as well as to public debt and global financial conditions, remain. In the previous edition of the FSR in November last year, we documented the outcomes of a stress test that was undertaken on South Africa's systemically important financial institutions. That stress test demonstrated that these institutions are well placed to withstand an economic outcome considerably worse than the SARB's baseline forecast. But the SARB continues to monitor developments closely and stands ready to adjust policy if necessary. Thanks very much, Governor. Back to you.
Thank you very much, Alex. And we now at this stage open this virtual floor for questions. Soraya, who is fielding the questions? Is it Yolanda?
It's Yolanda, Governor.
It's Yolanda. Okay. Ms. Vacha, who is asking what?
Governor, I'm going to ask you 4 questions, and then we'll move on to the next 4 after you've responded to the first set of questions. So the first 3 questions are from Emna Ramney from Reuters. The first question is, the FSR says that the SARB is researching other policy interventions aside from the FSLAM to address the risk posed by the financial sovereign nexus. Could you give some of the possible other interventions the SARB could pursue and how they would address the risks? The second question from Emma, Governor, is the FSR says the most widely used policy measure intended to mitigate the impact of COVID-19 is the allowance for banks to restructure credit agreements without holding additional capital. Is there any timeline for this to be removed? And does it foresee any material impact on the banks when it is? And the third question is, the FSR highlights the risk of the pandemic, that the pandemic could continue well into 2022 and the potential for a third and fourth waves of COVID-19 infections. Could you perhaps give some more color on how serious a risk this would pose to the financial system? And would you expect it to continue to remain resilient in the worst case scenario? And the fourth question is from Khomo Macheta. And the question is, how safe is cryptocurrency? I'm going to leave it at that, Governor. Thanks.
Thank you. Let's start with the last one. We had issued guidance as the regulators in South Africa in terms of warning people to be careful as they trade in this crypto asset. And I notice you used the term cryptocurrency. These things are not currencies. They do not meet the definition of a currency. A currency has got to meet 3 criteria. It must be a generally accepted medium of exchange. It must be a store of value, and it must be a unit of account. So that is the thing, and these cryptocurrencies do not meet this criteria. We are, however, concerned about people trading in this stuff. There are risks to money laundering and the financing of terrorism. And many of the ransoms that we have seen, whether they are cyber ransoms or not, people have asked to be paid in this cryptocurrency. So there are important safety issues there. So if you were looking for us to say they are safe and therefore you could go and invest, you're not going to get that. What we did say is that these assets can and must be taxed. So we had given that regulatory guidance. Then there's the question about the third wave and whether we would continue to be resilient in the light of the third wave. Well, the point is that we do not know how severe the third wave would be, and we also do not know how the response would actually come from the authorities. What we do know is that we cannot go back to a complete lockdown. Lockdowns across the world have become increasingly smarter, meaning that they are more targeted, more risk-based, and you would actually realize that even in our case, what we did was that the country went into a risk-based system where we had different levels at which we activate the lockdowns, and all of that had been risk-based and driven by the National Coronavirus Command Council. And so if this was to, the third wave was to hit us, what we would then have is that it could impact on economic activity. And if it impacts on economic activity, it could lead to a situation where borrowers get stressed or get challenged in terms of their cash flows and the loss, and which could impact on their ability to service their debt. Exactly what this would be, we do not quite know. What we do know is that the sector still has significant buffers that it should be able to absorb the impact of the third wave. And that third question has to do with the allowance for banks to for the restructure and how long this would be in place. We had always said that these things should be state dependent rather than time dependent, and I'm sure DG Naidu might come to that just now. Suffice to say that the banks have got the buffers to be able to sustain this. It's a big debate internationally about when these extraordinary measures get unwound. What has been clear is that we are not going to be in a hurry to just unwind measures because we believe the thing must be done by this time. Rather, it is focused on the state of it is state dependent. The good example here is the one from the bank's payment of dividends and bonuses that was linked to them being able to dip into their capital buffers. And when they said that they would like to pay dividends and bonuses, we said, well, if that is the case, you must know that you can't dip into your buffer. So it was state dependent. It depended on how strong the balance sheets of the banks were at that time. And many of the banks that had decided that they are going to be paying bonuses and dividends demonstrated that their capital and liquidity positions were in a decent shape and that they would be able to sustain that. Many of them had given that kind of guidance. The question about the other interventions to deal with the sovereign bank nexus, I think that we must be clear. The most important tool to deal with the sovereign banking nexus is fiscal consolidation. And so the Treasury had embarked on a path of fiscal consolidation, which we had seen that when they announced that they are cutting down on the weekly auctions, meaning that they are borrowing less, what that meant was that the financial system didn't have to absorb as much government debt issuance as they used to do at the height of the crisis. And same here, that the South African financial sector came to the party, because you must understand that the coronavirus shock came at the time when we were also falling out of key global bond indices. And when that happened, the South African financial sector was able to step in. But like we said, we are embarking on a research to identify what other tools might be there to deal with sovereign banking nexus. DG Kasim, you are the researcher. I am just the governor, you know.
Maybe I can add, Governor. Yeah, maybe I can add, Governor. Look, I think that you know, there are a multiplicity of reasons behind why commercial banks buy sovereign debt. At one level, it's a very attractive return, and it's logical, and it makes enormous sense. It also has a positive impact on the sovereign. It brings downward movement in the yield and so on. At another level, I think that you know, there is this argument, because it's a low risk weight, that may encourage banks to buy sovereign debt, although that is not the growth in ownership of sovereign debt is not entirely explained just by the low risk weights. So I think when we say that we want to do more research, we're really trying to understand what are the drivers of this? What is the threshold, the breaking point, where we really become worried about this interface between the banking sector and the sovereign sector? And I think that, you know, these are the kind of things we're asking. You know, banks have their own risk models or their own portfolio diversification models. So, you know, we want to better understand that because I'm sure banks have a threshold where they believe they need more diversification. To what extent is the fact that credit growth in this economy, which is very slow, impacting on the driver of more accumulation of sovereign bonds. So these are the kind of underlying issues that we're trying to get to the bottom of and understand better. Thank you.
Governor, if I can just add to one of your answers, are you correct that the most significant relief that we've provided was in what we call Directive 3 of 2020, which allowed banks to restructure COVID-related loans and not hold higher capital? The banks are already in a process whereby they're going through each of these loans and they're saying, is this still a COVID restructured loan, or is this now a bad debt? Is this a viable business model going forward, or is this business model outdated? And if they think that they cannot recover the money or are less likely to recover the money, they are having to put this in what would be called a distressed restructuring bucket, which does attract higher capital. So the banks are already doing this on their own. We have not set a clear date by when we will withdraw Directive 3. We want to see the banks take proactive steps to go through their COVID restructured loan books to weed out what is not or no longer viable businesses, no longer viable or no longer credible COVID restructured loans, to account for those properly as distressed restructured loans. And when we think that the banks have made significant progress in this regard, we will begin to signal the withdrawal of Directive 3 of 2020. As the Governor said, we've already signaled a date by when, or maybe Alex, we've already signaled a date by when the capital buffer would return back to its level. We have also not signaled a date when the liquidity coverage ratio would go back to back to 100%. So it's a gradual process. We don't want to rush this. We're quite confident that the banks are doing what they can to support their customers, but we also think that the banks have been quite prudent in how they restructured loans. What's the likely impact of financial stability if this is a long, protracted crisis with the third and fourth and fifth wave? To add to what the Governor said, it largely depends on the severity of lockdowns, and we think that globally economies have become smarter about this. Our lockdown in wave 2 was certainly less severe than wave 1, and there was less of an economic impact and therefore less of an impact on the banking sector, Chair. Thanks.
Thank you, Governor and Deputy Governors, for those responses. We've got more questions for you. The first set of questions is from Prinesha Naidu from Bloomberg. And Prinesha asks, could the loan guarantee scheme return in a different form after being wound up? Are there other options being looked at? If so, what are these options? The second question from Prinesha is the FSR states that funding conditions for commercial banks have not eased to the same extent as recent monetary policy adjustments. Why is that? Given this, does the SARB consider the monetary policy transmission effective? What more can be done by way of monetary policy to improve the conditions for commercial banks? And the next question is from Ed Stoddart from the Business Maverick. Ed would like to know, the FSR notes that the corporate debt defaults in 2020 were less than what occurred during the global financial crisis. Does that suggest that lessons have been learned from that crisis, which served the corporate sector well in the face of the pandemic? And the fourth question that I have for you, Governors, is from Razia Khan from Standard Chartered. As capital requirements normalize from 2022, are there any implications for monetary policy? How much of a consideration is this and weak credit growth for monetary policy? Thank you.
Gigi Rashad, if you could take the first two questions, and then between Fundi and Kuben, take the last two. Fundi, in particular, the very last one on credit.
Thank you very much. I know that DG Naidu may have more to say on the loan guarantee scheme, but one thing that we struck by is that in many countries the loan guarantee scheme utilization has really been low. So South Africa is really not an outlier, and I think it really boils down to the fact that our banks were pretty preemptive as the Treasury in collaboration with the SARB was thinking and designing the guarantee scheme, that the banks went ahead, restructured loans with their clients and so on. So in that sense, I think that the loan guarantee was important. The number of people used it. I think that the real dilemma that we face as a central bank is that at one level, it's quite important that we feel that the monetary transmission mechanism works. So we want to encourage banks to lend and make sure that we preserve the credit mechanics mechanism in a crisis. At another level, we also have to ensure that banks remain resilient. So kind of, treading that delicate line is very important for the SARB. And I think I can't in my mind think of another version of it. I think that the kind of instrument reviews have been most effective. Yeah, I mean, look, the thing is that some, obviously there's a box in the FSR that shows that funding costs have been slightly higher, but by and large, we don't think that significantly affects the banks. I don't think banks kept hold or kept back on held back on credit supply because maybe funding costs were slightly higher. There's an interesting relationship between what happens with deposit rates and when the repo rate goes down. Deposit rates don't move in the same absolute range as the repo rate, but one also has to see what happens on the other side of the coin, and that's the rate at which banks lend. So one has to look at the interest margin. So the interest margin in absolute terms will come down if the repo comes down, but one has to look at that relative to inflation. So we think the transmission mechanism does work. It is not unusual for funding costs to not come down at the same level as the repo rate, and that's how things just work. Thank you very much.
Fundi, after you. Oh.
Thanks. So, Razia, thank you very much for your question. So in terms of the monetary policy decision making, I guess one has to think about credit conditions in two ways. So we think about credit conditions in as far as they have an impact on overall demand and what impact that could have on inflation overall. But at the same time, we have to consider the decisions of previous monetary policy actions and how those interest rate decisions have transmitted into the economy. So when it comes to how the monetary policy decisions trickle down into the economy, the impacts have been different. So, for example, the way that banks access credit, for example, will depend on their own internal structures as banks. It will depend on investor sentiment in terms of the issues that they see challenging banks. The current economic climate also would have an impact on how investors think about the challenges that banks would be facing over the near to medium term, and Kuben can talk about this a bit more. So I think that we try to look at credit conditions in that way as the MPC. So let me leave it at that and over to you, Kuben.
Thanks, Fundi. Thanks, Chair. Chair, let me make 3 short points. The first is that credit is a function of both supply and demand, right? If there is uncertainty in the economy, if there is weakness in the economy, you're not going to get credit flowing. And we know that South Africa went into the COVID crisis in recession. So even before the COVID crisis, we had relatively weak credit extension. And there are all sorts of reasons why the economy was weak. There are all sorts of reasons why we had a recession in 2019, even before the onset of COVID. Reasons that have very little to do with COVID. We do think that economic conditions are improving, and we do think that demand will pick up. But credit demand is a function of both supply and demand. When we evaluate the loan guarantee scheme, we shouldn't lose sight of the wood for the trees. Our objective of policymakers is to keep the channels of credit flowing, to ensure that customers can get access to credit, that the banks can support their customers, that the banks can extend credit to minimize firm failure, minimize job losses. In the main, that happened. In the main, the banks did extend credit, the banks did provide payment holidays, they did provide moratoria on loans. There was a very significant amount of debt restructuring. And so when we evaluate the loan guarantee scheme, let's not lose sight of the wood for the trees. Let's keep in mind what the objectives of policy were and what has been achieved to date. I don't think that the loan guarantee scheme will come back in the present form. I don't think it'll come back in this crisis. That, of course, is a matter for the Treasury and the banks to negotiate. I think there are key lessons, perhaps for future crises, on how government and partial guaranteed support could support bank lending into the economy. But for this crisis, I largely think that we've met the objectives that we initially set out in 2021. The economy is in a very different stage of recovery today. That requires a different type of policy instrument, different types of tools. I don't think the loan guarantee scheme plays that role at the moment, Chair. Thanks. Sorry, there was a question about corporate defaults and whether corporate defaults have been lower and whether that there are lessons. It is true that the corporate sector has performed better than we expected. The bulk of the non-performing loan, the increase in non-performing loans has been in the retail sector, in the household sector, not in the corporate sector. And it is true that corporates went into this crisis with relatively healthy balance sheets, but it's also true that the banks were able to support those corporates to see through some pretty thin margins, some pretty large losses for between 1 and 3 quarters. Are there lessons? I think the old adage for everybody, whether you're a country, a corporate, or household, is if you go into crises well stocked, you're likely to be more resilient. Thanks.
Back to you, Yolanda.
Thank you, Governor. So the next set of questions is from two participants. Stephen Zanje from the University of Limpopo would like to know that to stimulate the South African economy further and increase the cooling period for debt holders, is a further reduction in the repo rate a possibility if the economic conditions do not improve? Stephen's second question from the University of Limpopo is that what proportion of public debt has been earmarked for productive investment versus recurrent expenditure? What measures could be implemented for South African debt to GDP not to break the 100% ceiling? If it's not the domain of the SARB, what role can the SARB play in this case? The next two questions, governors, are from Michael Potgieter from ETM Analytics. And Michael would like to know what level of government debt would the SARB flag as a more substantial risk to systemically important institutions? And the second question is, what would happen to bank capital in the event that the government were to miss a debt payment? And I think, Governor, can I just add one more question to that, which is from Khomuma Cheta also about what would be the acceptable level of public debt be? So that's all for now, Governor.
Thank you very much. It might be the last round of questions, but the questions from the University of Limpopo and whether we could be doing more to stimulate the economy. The monetary policy stance is highly accommodative as it stands. We are below our neutral real interest rate. Actually, the interest rate, the policy rate is negative in real terms. So let's not even begin to be worrying about whether monetary policy is accommodative or not. It is. We know that for sure. What amount of public debt is earmarked for productive investment? Wrong institution. Of course, that is the question for the Treasury to answer. What should be the level of debt that would be acceptable? There are all sorts of ways of calculating these things. You know, in Europe, they had a Maastricht and they arrived at 60%. Hardly anyone is at that 60% at the moment, and there isn't a very clear economic rationale how they arrived at that. But in an environment where many of the advanced economies are faced ultra low interest rates, these amounts do not mean much for them. But we are in a different space altogether. But what exactly would that amount be? We don't know. But the National Treasury has become very clear to say that where the debt trajectory is going is not sustainable and they are not compatible with it, which is why they embarked on a path of fiscal consolidation in a growth-friendly manner. And that is what should be the issue. Now, ETM analytics about at what stage does the level of debt become systemic? You would realize that in the FSR we have talked about the nexus between the banking sector and the sovereign is a question of how much do the banks hold in this debt. We get concerned for two reasons. Firstly was that if you remember at the time of the budget policy statement last year, the projected deficit was just around 15% of GDP, 14 point something, 20.7 or so projected. The savings rate in this economy was around 15%. What that meant was that the government would borrow the entire savings of the nation and leave nothing for the other investors in the economy. That would have been a classic crowding out effect. Fortunately, we experienced this positive terms of trade shock, which led to revenue surprising on the upside. That enabled the Treasury to cut down on its borrowing requirements and thus reduced their weekly auctions. And that meant that resources are released for the other parts of the economy to utilize the savings in a better way than just on funding government's recurrent expenditure. And the question, that question had to do with the amount of debt capital and at what point would we be concerned about the debt. I'm not sure how exactly the two actually quite link up. The truth of the matter is that the banks are well capitalized. And their capitalization has nothing to do with their holding of government debt. Government debt comes through the liquidity coverage ratio because the banks have to hold high quality liquid assets, and in this case, it's government paper, to meet their liquidity coverage ratio. The last time we checked, the banks were above the 100% necessary for the liquidity coverage ratio. The interesting observation to bring to the fore here is that when the liquidity coverage ratio was introduced in 2011-2012, the concern of the South African banking system was not that there is too much debt. Their concern was that there isn't enough debt for them to meet the liquidity coverage ratio. And so years of rising fiscal deficit meant that government issued a lot of paper and the private sector could meet the liquidity coverage ratio. So it comes through the liquidity coverage ratio. Then the next question was, would the bank's capital be able to absorb a sovereign if the government misses a debt repayment? This government cannot miss a debt repayment. Constitutionally, in chapter 13, it is stated that the government must first meet its obligations of debt that is falling due, debt that must be serviced before government allocates money for any other expenditure. So unless you have got a rogue government that decides to disregard the constitution, you cannot have this government missing the debt payment and that causing the kind of problems that you were actually thinking of. And I would believe that we have a government that is acting responsibly, and that is not what they would actually be doing.
Thank you, governors and deputy governors, for those responses. We do have a few more questions. I think it will be the last round. Yes, I think it will be the last round. Governor, it's going to be a bit of a mouthful, but I'm going to try my best to get through this last round. So the first question is from Kim Silverman from RFB. And Kim wants to know, did the IMF provide a reason for the greater impact on South Africa's economy from COVID-19? The second question is from Andrew van Dam from finboffs.com. Are there any cheaper tools that the SARB has to dampen inflationary pressures? And I think you did touch on some of that in your previous responses, Governor. The third question is from Mfunego Toyana from Reuters News. Has the bank considered and quantified the environmental impact of cryptocurrencies/assets? If so, what have you found? The fourth question is from Peter Attard Motlanto from Intellidex. And Peter says the FSR briefly mentions climate risks, but stranded asset concerns of banks and investors are rising after the recent IEA report. And with new events coming up, such as the 3 gigawatt gas procurement round later in the year and the car powership financing drama now, what message can the governor give over stranded assets risks being introduced now? And then we've got Kwena Mapagela from the YouTube channel. And Kwena would like to know, should commercial banks increase high-risk loans to stimulate inflation? And a final question from Divone Chitenje from Stanlib. When is the SARB's next stress testing, and what will the focus of the stress testing be, and how are you accounting for COVID-19 in your scenarios? Thanks, Governor. I think that covers it for now. And that is the last round of questions.
Thank you very much. I don't know why we should stimulate inflation. There are two questions which are very interesting. One says, what cheaper instruments can you deploy to dampen inflation? The key instrument is the policy rate. It is not just, I don't know what cheap or expensive is, but it is the most effective tool. That is what all central banks use, is the policy rate. That's what we use to contain inflation. There is no virtue in high inflation. So there is no reason for this central bank to try and stimulate inflation. Central banks in the advanced economies would like to stimulate inflation, or wanted to stimulate inflation, because they were at the zero lower bound. Be careful what you wish for. you might just get it, and when you get it, you might not like it, and it looks like as the data comes, people get concerned about the specter of inflation in the advanced economies. I'm going to leave Rashad to deal with the climate questions. Peter, we can't help you with the individual transactions that you referred to. And I do not see how those individual transactions link to the climate risks that you would like to talk about. So we will talk about the climate risks and the that we see for the sector, and I will ask Rashad to deal with that. Fundi, I don't know if you saw this thing about the IMF and what they say about the greater impact on of COVID on the South African economy. Whosoever had seen it, I haven't seen it, if they could do that. And then, Rashad, would you also deal with the environmental impact of cryptos? I'm not aware that we have done anywhere, but these things use a lot of electricity.
Thank you.
So shall we distribute it? Yeah.
Okay.
Governor, sorry,
Governor.
we have a question on the stress testing also.
Yeah. Okay, I'll deal with
It's
that.
Rashad.
Yeah. I should just say that I'm very pleased that someone is asking a question on stress testing, because it's a very important part of the work and the toolkit of the Financial Stability Department. We are in the middle of a major stress test, and obviously for the stress test to be important and relevant, we obviously stress very severely the state of the economy, comparable to what happens in COVID-19 and so on. So I would say, watch the space. It's likely that we will have a stress test report in the next FSR. So just to say that we are in the middle of a stress test. Yeah, look, there's not much I can say on the environmental impact of crypto. Is it more environmentally damaging than cash? That's something that I'm kind of, we have to ask. There are all sorts of pros and cons either way. Sometimes it could be better for an environment in some respects, in other ways not. On the question of environment, I mean, just answering, the governor referred to Peter's question, but just answering in a very generic sense. I think that many central banks in their financial stability risk assessments are flagging climate risk. I guess not for the sake of it, we don't flag it because every central bank flags it. I think it has become a more serious concern. I think that the hard part is making the stronger links between climate change and systemic risk. At one level, it is obvious that if the frequency of droughts or floods continue, it has particular exposure for the insurance industry. If the insurance industry is an important player in the financial system and it is stressed, there are implications that way. This is really preliminary work which we're doing more in-depth analysis of. At another level, if there is a strong move to simply invest in green bonds that doesn't produce dirty emissions and so on, that may have implications, we know, for some SOEs and so on. That in itself could result in exposure of corporates who are kind of heavily invested in kind of dirty climate, so to speak, a dirty environment. So I think that it's in the report we talk of the physical risk, the transition risk of moving to a more carbon neutral environment. Will that have any implications? But I'm speaking really generally, but that's why we include climate risks in the report. I'm not speaking directly to Peter's question though. Thank you.
Thanks, Governor. If I can come in, I think, Peter, just to add to what Rashad has said on climate issues, this is a conversation, of course, that has to happen, not only within the central bank, but there's a role for governments who are the ones who set climate policy, and a conversation to be had with financial institutions as well. So when we're thinking about the projects, there are the planning aspects of the projects, the financing aspects of the projects that the funders of the project have to think about themselves, and then there are disclosures that we have to monitor as a central bank going forward to say what are the risks that we are seeing these institutions being involved in, and it's an evolving conversation. I thought I should add that. Kim, I haven't seen anything from the IMF, but what they have said in the prior discussions about COVID and how countries could be affected differently by COVID is that the rate of vaccination in those countries would have a large impact on how fast the recovery is. They've also highlighted the issues around scarring. And that there might be more permanent scarring, where there are some industries that have got half of that industry being wiped out, and we've seen sectors such as tourism and also just the broader travel industry being largely affected by COVID. They've also highlighted that countries that have got higher levels of macroeconomic imbalances will also be adversely affected by COVID because of potentially changing financing conditions and the longer-term impact on the government balance sheet in terms of the way that the COVID restructuring or the funding of COVID-related projects and government interventions has taken place in those countries. Thanks, Governor. I think I'll stop there.
Thank you, DG and Governors, for your responses to those questions. And we've closed off the question round. Back to you, Governor.
Thank you very much, Yolanda. Thank you very much, everyone, for attending. And I would like to hand over to Thoraya. Thoraya, any last words?
No, Governor, thank you.
Okay, well then, thank you very much, everybody, then, for your attendance. For those of you who come to the Monetary Policy Forum, we will see you at the Monetary Policy Forum. For the journalists, we'll see you at the MPC in July. And the analysts, we will see you at the investor meetings after that. Till then, goodbye.